Hello all, welcome to ETF Edge, your go-to place for everything ETFs. I'm your host, Bob Pisani. NYSE floor, of course, is temporarily closed, so we are coming to you remotely on a very big day for the ETF industry. That's what we're going to talk about. Joining me now is Dave Nadig from ETF Trends, Todd Rosenbluth, Director of ETF and Mutual Fund Research at CFRA. Let's start off with this bombshell announcement from the Federal Reserve, Dave, not just buying treasuries and mortgage-backed securities, but also buying corporate bond ETFs. That was a surprise. What does this mean for the ETF community, Dave?
Well, obviously, it's a good thing. It puts some buying pressure under what has been the most pressured part of the market. As much as we've been talking about what's going on in equities, what's gone on in bonds here is really unprecedented. And so seeing the Fed make this move is also unprecedented, but not necessarily unexpected. After all, we have plenty of examples of other central banks doing things like this. The Bank of Japan has been steadily buying ETFs in that market for going on 6 or 7 years now, to the point where they now own 80% of the issued ETF assets in Japan, about 5% of market cap. Now, most of that's been focused on equities, but I think we'll see something like that here in the U.S. My hope is that they participate broadly in the market, not just in ETFs, but across the bond spectrum.
Well, that's a good question, Todd. For example, I mean, it certainly wouldn't be a great idea, I would think, for the Fed to just simply start buying corporate bond ETFs like the LQD. I mean, there is the question of the underlying assets, right? I mean, should the Fed also be paying attention to what the prices of these bonds are underneath it? I mean, it's the mechanism here and how they're doing it that I'm not quite sure of yet.
That's a great point, Bob. So what we have with ETFs, as most viewers know, is that an ETF has a price that it trades intraday, and then there's a net asset value, the value of those bonds inside. And so what the Fed appears to be doing is not only offering a bid or putting a bid for the ETFs, but more importantly, for the bonds that will often be inside the ETF. Corporate issuers and investment-grade corporate issuers like AT&T and JP Morgan, Bank of America, those are widely held within LQD and other investment-grade corporate bonds. If you put too much pressure on the price to drive that higher and not similarly on the net asset value, then you'll see a premium, which is, of course, the opposite of what we've been seeing in recent days and weeks, where we've been seeing a significant discount to net asset value. The bonds inside are not trading, and thus they're impacting the way that ETFs are being priced.
So, Dave, let me go back to my first question. How does this change the ETF community? We now have the federal government, we have the Fed, essentially, as a competitor for certain ETF asset classes. I'm philosophically trying to figure out what that means. I know Japan's been doing it for years, and they've also been buying equity ETFs. That's not happening here yet. But you want to ruminate on what that means for everybody? It's a bit of a different change of mindset.
Yeah, I mean, it is unprecedented for the government of the United States to own the corporate debt obligations of the private enterprises in this country. That is new territory. Now, short term, of course, we know what this means. Buying pressure that'll bring up the price of the ETFs. Hopefully, it will also mark the price, as Todd was saying. It'll help mark the price of some of these untrading bonds if they go out and start being the buyer of last resort there. They're still going to be at pretty low prices. Now, I think it's important to point out the initial facility that they're putting in place to make these ETF purchases has some limits. So it's not like they can all of a sudden own the whole bond market. They're limiting themselves to a fairly small percent. I think it's something under 20% of the existing issuance of any one of these securities. So they're not going to become a dominant player. And I think that's an important point here. We're collecting a bunch of assets, presumably for a short term, much like we did with TARP back in 2008, 2009, right? That was, again, the government stepping in to own assets they don't traditionally own.
And if I can just add to that,
presumably for a short term, you're right, Dave. It says the facility will not purchase more than 20% of the assets of any particular ETF. But I wonder if that's comforting at all. Has the Japanese given back any of the ETFs that they now own? I don't think they're sellers of any ETFs, are they?
Well, what they've done is they've actually made them available for loan. And that was a fairly recent development because they now own about 5% of the market cap of every company listed in Japan. We're a long way from anything like that happening in the U.S. Although certainly I think what we're talking about, some of the buybacks on the equity side, that's going to start looking pretty similar, like the U.S., and that means me, a taxpayer, is going to have a share of these giant corporations. So I do think we're headed for something like that. I don't think it's going to be a long-term buy and hold position, kind of like what we've seen in Japan. Japan doesn't show any signs of really unwinding that. I suspect this Fed facility is going to be much shorter term.
Todd, you were going to say something? I'm sorry, interrupted.
No, that's okay. I was going to say that because there is a 20%, they don't want to own more than 20% of it, and they've put in a dollar amount of what they're prepared to spend for both ETFs as well as corporate bonds. You really have a handful of these corporate bond ETFs. You mentioned LQD. I would put some of Vanguard's suite of products like VCIT, that's Vanguard's intermediate term corporate bond ETF. Those are $20 billion or plus assets under management products. Your more $1 billion or perhaps even lower corporate bond-oriented ETFs from various other providers just won't meet the threshold. The Fed doesn't want to move. They don't want to own too much of it, and it probably isn't worth their time to be owning $100 million worth of one ETF and $100 million worth of another ETF. And so this is.
So what are they going to do? Just buy all? It's iShares and Vanguard that sort of control a lot of this. So you're suggesting that the Fed's basically going to buy a small group, a small fund family group, maybe Vanguard and BlackRock, for example.
Yes, this is likely to be in iShares, Vanguard, and even State Street. Some there, but to a lesser extent, some of their corporate bond ETFs are $5 billion or higher in assets under management. I would repeat what Dave said. This is likely to be a short-term phenomenon, but it will help all the other corporate bond ETFs if they're buying the underlying bonds of AT&T and JP Morgan and Coca-Cola. That helps the securities inside the portfolio, which will help to bring the net asset value back to more of a stabilized level for the foreseeable future.
Yeah, and I want to emphasize,
Bob,
we're talking about corporate bond purchases. There is no talk of the Fed buying equities or equity ETFs. Is that correct, gentlemen? I just want to clarify that for everybody.
That at the moment, this is all part of this special corporate credit facility that they're standing up. But look, I think all bets are off, right? Major policy changes are happening day by day here. Things we never thought we'd see in our lifetime are getting dropped every 24 hours. So at the moment, this seems like where the line in the sand has been drawn. I think it's really important to understand this is not the federal government going to buoying the entire market necessarily. They're explicitly not going to be buying ETFs that come up at a premium. So if they manage to sort of reestablish equilibrium in the market, theoretically, that stops the purchasing, and then the market can go back to resetting prices. This really ideally would be mostly an open market activity in the corporate bonds themselves. I think they're talking about ETFs here really just to help give some comfort to folks who are in that highly liquid ETF market.
Okay, let's move on a little bit. I want to talk to you both about interesting developments in spreads in some of these ETFs. We've heard some bond funds, LQD was one example, recently traded at a much wider discount to their net asset value than usual. Some are blaming ETFs, but Dave, you pointed out that what seems to be broken here, if broken is the right word to use, is the bond pricing services. Can you explain what you mean and address this whole question?
Sure. At the simplest level, if you're a bond indexer, say a market, an IDC, a Bloomberg, you're putting that index out, you have bonds in your membership in that index that may not have traded for days or weeks, particularly less liquid securities like high yield munis. But at the end of the day, you still have to price that. You still have to put a net asset value out there as a mutual fund or as an ETF. The way you do that for something that hasn't traded is you have to have some kind of a model. And traditionally, what that model does is look at the last time that bond traded, see what similar things have done, and then adjust that untraded price to come up with some estimate of fair value. That sounds fine. The problem is those models do not react very quickly. They tend to be lagged by days, if not longer. So when you have a hyper liquid market with a hyper volatile movement in price, like we've seen across the entire fixed income market, those services lag. So what happens is the NAV stays stuck at an artificially high level. not because those bonds are worth that much, but because the pricing service hasn't recognized the new reality. That new reality is what bonds are trading well underneath it. So you're creating this artificial gap. Go ahead.
So your point, Dave, your point is it's the ETF guys, the guys who are buying the stuff, they're getting the pricing right because they're reacting instantaneously to the way they feel the market should be, and it's the bond pricing that's lagging. My point here is that the ETF haters are out there saying, aha, you see, there's a couple of these bond funds, and they're pricing it. The ETFs are pricing at discounts to the net asset value. What's that all about? That must mean the ETF model is broken. Your point is it's the guys buying this who've been right all along, and the market's slower.
And it's actually going to get, I think it's going to get worse for the mutual fund industry. We've already seen this outside the United States. We had 30 open-ended bond funds in Sweden close last week because of this exact issue, that they could no longer guarantee that those prices were good, that they were real. We're going to start seeing bond mutual funds in the United States have to close for redemptions, because what happens is if you get out at those exaggerated prices, that forces the mutual fund to sell to make cash to meet those redemptions, hurting the leftover shareholders and forcing the NAV eventually down towards fair value. But there's a real discrepancy here between the instantaneous price discovery of the ETF and the lagged NAV of a mutual fund.
But Todd, isn't this at heart still just a buyer-seller disagreement on the prices, right? I mean, Dave says the buyers are right. I tend to think that that's probably the right way to look at this. But it's still there's an issue here that there's been some discrepancy between the net asset value and the ETF prices. How does the market address this during times of stress? Is there an answer other than just you guys have got to move faster on your bond pricing?
Well, yes, I think that's probably a solution to it. But I think to your core question of the buyer versus the seller meeting, that's what's happening at the ETF level. The buyer and the seller are agreeing on a price. That's what we're seeing for the price of the ETF, like LQD or MUB or some of these other liquid products, whereas the net asset value is based on the buyer and the seller of the bonds. And when there's less activity there, there's going to be a lag behind that. So I agree. I think the ETF is more right. I don't think either the ETF or the mutual fund that's based on net asset value is correct, because this is moving so quickly, and the bond market just is not as liquid. ETFs make it more liquid, but it's not. They don't provide instant liquidity.
Yeah. So, Dave, is there an answer to this other than tell the bond guys you got to sell your stuff faster and get faster pricing? What's the solution here? Because it seems stupid to blame ETFs for this, and yet that's what some people are trying to do.
Well, this does play itself out naturally, right? Time eventually cures all wounds. And we've seen this. The net asset values on these bond ETFs and mutual funds are starting to plummet down to the levels we would expect them to be at based on where prices have actually been in the market. So time does solve this problem. But fundamentally, what's broken here is the valuation of untraded assets. And that's happening at the NAV level in both ETFs and in mutual funds. Right. That's not going to get fixed overnight. That's going to require major structural changes to how our credit markets work. I don't see that happening in the short term.
Right. So the point here, I'm trying to lead you on here, the point is that this is a commentary on the structural set of the bond market, not whether the ETF market is part of the problem. The ETF market is the one trying to figure out what the real prices are, and they've gotten things remarkably right. I keep commenting on how well they did estimating the Chinese stock market when the market was closed for more than a week. The ETF seemed to accurately price where the stuff was really going to be trading.
Exactly. And that's what we're starting to see now. Okay. We're starting to see those things come together.
Okay. Let me move on here. One of the things that's odd we've seen recently is bond prices moving down across the board recently. So corporates down, high yield down, and muni bonds. Now, we don't normally talk about muni bonds. The big one is MUB. There's not a lot of ETF activity, but MUB is pretty big here. And people kept asking me about this. And, of course, we had to remind everyone it's these municipal bonds that pay for the transit systems and that pay for the convention centers in all of these cities. Dave, do you have any observations on this? The minute they announced some support for muni bonds from the Fed, it started to stabilize a little bit. But it is a very good reminder of what these things do out there. Nobody quite ever thinks about, why would a convention center ever be in any trouble or anything like that necessarily on a very broad level. But we saw that concern.
Well, and a lot of times these are revenue bonds. Like a lot of times they are directly tied to the performance of a municipal facility, like a convention center, like a toll highway, something like that. And all of those things are going to get hurt just as much as Marriott and Boeing are going to get hurt here. Unfortunately, most municipalities don't have the backdrop of, say, corporate equity where they can issue fire sale secondaries and things like that to rebuild their businesses. So I think it's obvious that there's an increased chance of default in the average muni, just as there's an increased chance of default in some energy bond, right? Those are going to be pressured as we go through the bottom of this recovery and figure out what the real damage is. So the sell-off in munis makes as much sense to me as it does the sell-off in high-yield energy debt.
But I would add to that, if I could, Bob. Sorry, if I could add quickly to that municipal bonds tend to be more mom-and-pop individual investors. They're bought and held, so they tend to not trade. So whereas we've certainly seen pressure on the revenue side of this, there's just less trading volume for these individual bonds inside MUB or some of their peers. And so it goes back to the same problem we talked about earlier. If there's no buyers of the bonds, it's hard to price it's hard to price the bond ETF accurately.
Right. Well, if you think if you think we're somewhere near a bottom, the yields are certainly a lot better than they were a month ago. That's for sure. Let me, Dave and Todd, let me just before I let you go ask about. There's been some reports about exchange traded note liquidations. We've seen some forced liquidations of these ETNs. This is a good time to remind everyone. Maybe Dave, you can give us 20 seconds on this. The difference between an exchange traded fund and an exchange traded note, and why there has been a few liquidations of these exchange traded notes recently. Just briefly explain that.
Sure. So an exchange traded fund is basically just a regular old mutual fund that you are allowed to trade on an exchange. An exchange traded note is a piece of corporate debt. It's coming generally from a bank like a Credit Suisse or a Barclays, and it's promising a certain pattern of returns until that debt matures. These get used primarily for exposures that are difficult to put in a fund wrapper, like, say, inverse volatility or leveraged volatility, right, or other interesting patterns of return. So what happens is these have to be offset by some bank's risk management desk. And when they lose their appetite to take more of the hedge against that ETN, they really have no option but to close that ETN or delist it. We've seen some delistings. We've seen some closures as these banks are unwilling to keep providing that exposure. Again, it always comes back to what my friend Todd here says. Know what you own and know why you own it. You've got to understand what's under the hood.
Yeah.
And I would add
the exchange trade. Go ahead, Todd.
Sorry about that again, Bob. I would add quickly that the exchange-traded note market is extremely small. So it's probably a low single-digit percentage of overall assets. There's more products out there than there are assets. So they get headlines, and we're appropriately talking about that. But it isn't causing the underlying securities to move any more than we saw, SPY outflows impacting Apple stock.
Yeah. Okay. Guys, I'm going to have to leave it right there. Thanks very much. Very stimulating discussion. Quite an extraordinary week and an extraordinary day. And that does it for this week's ETF Edge. I'm Bob Pisani. I'm your host, of course. My thanks to Dave and Todd for their input, for joining us today. And thanks you for watching. This really been quite extraordinary. You can find all of our latest videos right here on our website. That's etfedge.cnbc.com. We're going to see you next Monday, same time and same place, coming remotely, at least for the time being. Thanks very much for joining us, everybody. Have a healthy, happy, and safe trading day.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.